Hi, everyone. I'm Michael Greenberg. I'm the SVP of Growth here at AMPECO. I'm based at the edge of Silicon Valley in San Francisco, so very exposed to the technology world in the United States. So we're going to cover in the next 25 minutes what's going on in the US, what people can learn and take away in Europe. And ultimately, we're trying to help people understand what the differences are and have some takeaways if you're starting to think about expansion or other lessons from the US. So start with our panel. I guess we'll start with tradition, introductions, and tell everybody what you do and why you're here.
Great. Well, firstly, thank you, AMPECO and Michael team for the invite, Rohan. Great to be on the panel with you. Hopefully everyone here knows what Hubject does, given the context of where we sat. But maybe just to give you a perspective of Hubject North America, we've been in the market now since 2019, but really it's been in the last 2 to 3 years that we've seen ourselves grow. We offer the same platforms we do here in Europe, obviously to global customers as well, but we'll get into it a bit later. I think we've seen the market evolve in North America very differently actually to Europe. But now we have a team of 8. I'm based out of California. Southern California, just down the road from Michael. But glad to be here and looking forward to the discussion.
Great. Rohan?
Awesome. It's great to be here. Thank you guys so much for partnering on this panel. It's great to meet you. My name is Rohan Puri. I'm the co-founder and CEO of Stable. At Stable, we help make CPOs profitable. And the way that we do that is by helping you find strong locations for your charging infrastructure with the site selection and utilization forecasting tools. And then we help you operate your infrastructure at the best possible margin by dynamically adjusting the prices of your chargers. So we think location and price are the 2 fundamental variables for a profitable charging network, and now and into the future for the strength of the asset class. And so we use predictive models to predict what the utilization will be at a location, to optimize the location, and predict what utilization will be over time, next week or the week after, to optimize your price, to ensure that you have that long-term sustainable revenue flow. So we're the leading tool in North America today, serving all sorts of CPOs, asset managers, infrastructure investors, giving them confidence in their investments before they make that capital deployment, and then, of course, optimizing it afterwards.
Great. Thank you. So just a quick level set about what's going on in the United States. Some of you may know we had a slight change in the administration, which led to a slight change in policy in North America. But what everyone has to remember is that the IRA, so the Inflation Reduction Act that was under the previous administration, actually led to a pretty significant spike in EV sales in the United States. Also, a lot more investment in EV infrastructure, but they didn't happen at the same pace. So what you saw was a spike in demand, but without a spike in supply. So we've actually seen the ratio of EVs to fast chargers go up in the US, unlike Europe, which has actually come down. So we're actually at about the same level. So there's actually a lot of very comparable data in terms of what's happening in the US versus Europe. So I think there's some lessons learned for everybody here as well in terms of what you're seeing in North America. But what that means is there's a pretty good opportunity. I think there's still a lot of opportunity for CPOs to grow and to capture share and really kind of figure out a way to compete effectively in North America. And that's kind of where we are now. How do we become profitable? How does the ecosystem work with all the players in a way that we can cross the chasm? If you saw our keynote in the main stage, that's really what's happening in North America. We're at about 9% of sales at EVs, much lower than Europe. And with all those kind of demand drivers out of the way, we're gonna see how do we go from that early adopter to that early majority. So it should be an interesting time. But I think we'll start with there. So given that as the backdrop, what do you see as effective strategies for CPOs in the ecosystem in North America? And I guess, Rohan, we'll start with you.
Yeah, I think in North America, we have to look to places like Europe to understand what a mature market will look like. And the sooner that CPOs open up access to their charging infrastructure, the more open they are with how they're choosing sites, how they're opening up their protocols, how they're collaborating across platforms, I think the stronger the success there will be. So one of the key strategies that we really push for is, as sad as it can sound, right? You have to think of EV charging like an asset class that will be commoditized if it isn't there already. And so don't think so much about your brand and your brand recognition and those variables. Really focus on the fundamentals. what is going to bring strong value and performance to you on the public stage? If you're a publicly traded company, how is your network going to be valued? And that's going to come down to location and price. It comes down to utilization and margin, right? The best chargers, most conveniently located chargers at the best prices will tend to win out, regardless of what network they're in. And so we think of EV charging like we think of fueling. So the more sophisticated players now in the North American market are emerging. There are now PE funds and infrastructure investors. There's a shortage of public funding available, and there's a shortage of investor sentiment available to deploy into this type of CapEx. So you have to be much more strategic about where you're putting that infrastructure and how you're operating it. So one of the key changes in now is that it's no longer a time of surplus. It is a time of strong economic fundamentals. And strong economic fundamentals for a relatively low margin, high volume business means operational excellence, data analysis and data science going into everything that you're doing. And I think really break off those handcuffs and say, okay, if we had to make sure that anyone can charge at my charger, and I can always charge what is the most fair price right now, what would you be doing? And you would be plastering your charger on every app, on every platform, transparent pricing, open availability, open to all fleets. You would want every single person showing up. So that's one of the things we really encourage.
Great. Trisha?
Strong economic fundamentals, I think that's great. Just to build on that, I think what we're seeing is, I just sat on a panel with a gentleman from Toyota North America, and he said it was great to be at ICNC and see all these companies that are competing against each other actually get together and talk about how they can push the industry further. I think one of the challenges we had early on in the North American market is, especially with the CPOs, is everyone was sitting in a silo. Not just from technological implementation, but even just from collaboration around standards, these sorts of things. I think that's starting to change for the reasons that Rohan and Michael mentioned. There's pressure on the market now that makes CPOs really become cognizant of the fact that there's a lot of other companies out here that are doing roaming or optimization on pricing, but it doesn't just stop there. And I think they're starting to see that and open up to those conversations. But that's something that I'm seeing now that perhaps we didn't see 2 years ago.
Right. I mean, we're actually talking to a lot of companies that have private equity starting to breathe down their neck. I mean, there's no doubt that we've gone from that rah-rah days of 2021 or 2022, and now everyone's turning into an accountant, right?
Yeah.
Or a CFO. So it's very much about, how do I turn this into a profitable business? How do I actually figure out how I'm going to take 2 or 5 or 10 or 12% out of my expense structure and actually make some money?
And Michael, to that point, we now know that consolidation is happening,
Absolutely.
right? It's starting to happen in North America and in Europe. And Stable, because we do site diligence, utilization forecasting, we happen to be at the center of a lot of these transactions that people are doing. They're using our tools to understand value. And guess what? Guess what they're looking at in terms of value? Utilization, margin, and maybe the lease, like the value of the lease and the length of the lease. They're not really accounting for, in these acquisitions, they're not accounting for the brand value, and it's just location and margin, and what is the fundamental hardware? Is it strong, reliable, high power hardware, right?
Well, and I think looking at what are you actually learning? What are you seeing in terms of driving profitability? I mean, I know that that's pretty much at the center of your value proposition as a company. I thought it'd be good just for everyone to hear, what are you really seeing? What's actually happening? Where's the money actually coming from?
Yeah, I mean, I think what the strategy before is, if we build it, they will come. So we deployed a lot of chargers anywhere that it was easiest to deploy the chargers. And easiest means there's power, there's a permit, there's a willing site host, and I've signed this lease. I might as well put chargers on every property. What we found out is that that's not a very successful way to do it. Now I'll give you an example of a customer we can't help. So like I said, we help customers price their infrastructure by either helping them with suggestions or data that they can use to power their own suggestions. Sometimes customers come to us with a very low utilization rates of their charging infrastructure, saying, my chargers have extremely low utilization. I want to try pricing techniques to see if I can drive up my utilization. Now, some of these customers, they'll have 1 session per day, right? And at that point, price is not the problem, right? There's very little that price is going to be doing to drive better utilization on your infrastructure. And so some of those customers, we have to say, I'm sorry, we can't help you. It's the location is the problem, right? Or your reliability, and you've lost that loyalty because your reviews on PlugShare, Google Maps are so poor. So again, it's just like focusing on the fundamental driver. Now in the US, we have the complication of these many different utilities, all with different energy rates. So location is not just a function of how many drivers you're going to get at your site. It's also a function of what your energy cost will be, and your energy cost is dependent on which utility region you cover. And I think a lot of CPOs just didn't do that math, unfortunately, and they're using all these techniques to balance out things, battery packs, load management software, to handle those energy costs, when actually the solution was probably to never deploy in that utility region in the first place. So what we would love to see more of is an acceptance of the fact that some of those assets will not pay back. Better to liquidate them now and invest elsewhere, rather than pouring more and more money into a losing asset, right? And we really have to start thinking about it this way.
Yeah, I think rip and replace is definitely like something that nobody really wants to talk about, but I think the path for a lot of these locations is going to have to go that way.
Yeah.
So Trishan, in terms of profitability, like what are you seeing as well?
On the CPO side, I think Rohan touched upon it as well. But from our perspective, a lot of the CPOs early on were trying to do everything, right? Everyone took the kind of Apple approach of we want to be the hardware manufacturer, we want to do the software, we want to do the full CPMS. But what we're finding is that actually, to Rohan's point, it's really honing in on what are the economic fundamentals. Where do I want to be profitable as a CPO, and where can I bring in partners to help? The location piece is interesting as well, right? We speak to obviously a lot of EMSPs that tend to be in the US, at least OEMs as well, and a lot of the time, entire networks aren't showing up on their POI or their app because those networks have their own app, but they're unwilling to connect to third-party apps. Now, in Europe, we see that, and obviously to the utilization question as well, it's not just pricing, it's drivers knowing that they can find the charges. So one thing that we're really working on is just providing as much access to drivers for networks. And the other thing, of course, is simplifying the connection to networks for drivers and EMSPs, so making that as seamless as possible through obviously our roaming hub, but also bringing in technologies like plug and charge, which mean that the customer doesn't have to think about it. And what do you know, when it's an easier experience and it's more reliable, people will use your chargers.
Yeah, I mean, everyone has seen the numbers, we know the research. The higher the success rate on that first attempt, the happier the customer is going to be, the more likely they're going to come back and use that location again. Fewer people turn around and drive away. There's just a lot more revenue there as reliability goes up and trust goes up. One of the interesting things from talking to CPOs here is that it appears that utilization is actually lower in Europe than in the United States, which I thought was really, really interesting. And I think that's an interesting opportunity for European players that are thinking about potentially either learning from the US operators or actually investing in through acquisition or expansion into the US, that if they've figured out how to make money at a lower utilization here and they can replicate that model in North America, there may be actually a pretty good opportunity for the European players. So if we think about starting to get into that next chapter, right? Start thinking down the road. Where do you see the US going in 2 years? So look at the 2-year horizon, which is, I think, within the operation horizon of most companies today. And Trish, you want to start on this one?
Yeah, I think we've kind of alluded to it, but the next 2 years is really, I feel like, a transitional period for the market. We're going through what it felt like Europe was going through a few years ago, where a lot of the smaller networks, I think, are having their business models and their fundamentals really have pressure put on them. But out of that, you'll have some more interesting offerings, I think, and also some consolidation. On the other side of it, you also see a number of big players in private equity that are now saying, well, this is an opportunity to get into the market and really see where we can take it. So Walmart has now decided to go into the CPO network game. Utilities, as Rohan has mentioned. But I think we're going to see the landscape start to shift a little bit from the kind of startup, scale-up CPOs into some of the bigger players, C-stores, retailers, oil and gas, in the next 2 years. Beyond that, I think we'll start to see a very different industry.
2 years, what do you see?
I think what I see is for every maybe we'll put it this way. For every dollar that's disappearing from the government, we're going to have $2 of private investment. And I think that's a really good thing. Of course, as a matter of fact, we will have some consolidation. Some companies will not make it through. But the fact that large PE funds are emerging, to me, is a really, really good sign that there's strong fundamental IRR in EV charging now, and they see this as an opportunity. Now, if you look at, before Trump was elected, you look at utilization rates before Trump was elected, and you look at them now, I mean, they're the same or better, right? There's nothing fundamental to the asset that is less valuable. But the lack of liquidity, the lack of funds available to invest in infrastructure, and the headwinds that the market is facing means that the market is now undervaluing the asset class, which is exactly why these PE firms, call them what you want, roll-ups and vultures and bottom feeders, right? But they're seeing an opportunity where the assets are up for sale at a cheap price. I fundamentally know that EVs are the future. So if I can buy them now, my IRR is much easier to achieve and at very low risk, because guess what? I don't have to install them. I can just look at them today, look at their current utilization rate and their history of utilization growth and outages, and I know exactly what I'm buying. I know exactly how to value that, and I know what that could be in the future. Now in the US, because we have this lack of public funding coming about, I think what you pointed out, Michael, which is this ratio of drivers to chargers, may get worse. In fact, we'll probably see fewer new entrants, but more EVs still. And so each charger might benefit from better utilization. And some other effects that we see here in North America, and not necessarily in Europe, especially in places like UK. In the US right now, competition is actually a good thing. If you deploy a charger and your competitor deploys across the street, actually both of you benefit from better utilization because there's just more availability of infrastructure available. People are less sensitive to price right now than they will be in the future. The undertext of that is there's more margin to be made now than there may be in 20 years when it's a hyper-competitive and saturated market. And we actually see these effects in the Nordic countries already, right? The competitive dynamic is much higher, so there's less flexibility in how much you can move. So I'd actually argue that the next 5 to 10 years, I'm looking a little bit beyond the 2-year horizon here now, is the best time to make money in EV charging infrastructure in North America right now, because you can acquire assets for cheap, you can control your prices with less limitations, and you have much more control around factors like deploying or acquiring assets that are where rideshare hubs are operating and things like that. There's so much of a shortage of infrastructure right now. It's much less competitive.
If I may add, I think I completely agree. I think the data just shows that the industry is trending overall in the right direction, but because of the headlines, I feel like a lot of companies are reluctant to make the leap. But it's actually a great time. And I think the other misconception is, if you look at the US as a whole, it's obviously a big country with a population dispersed throughout. We often see the new vehicle sales are at 10%. Now in Europe you go, 10% of new vehicle sales being EV, it's pretty low. But if you take a state like California or New York or others, California's 25% of new vehicle sales are EV. It's probably a little bit higher than the last time I saw the numbers, but there is regions within the US that are developing at a much faster pace from EV adoption, but we're also seeing on the CPO side that there's regions that are neglected, right? Where a lot of the larger players concentrate where the volume is, but and maybe neglecting some of the regional areas or other parts of the country where EV adoption's starting to build also.
Yeah, people seem to forget or just how many markets there actually are in the United States, right? I think there's 314 different metropolitan statistical areas in the US. Every one of those essentially represents a city of 50,000 or more, and every one of those is really its own market. So there's a lot of, again, it's a big country, there's still a lot to do there. So one thing, when AMPECO was founded, one of the things that the 6 guys sitting around in a room talked about in the very earliest days was, don't think about right now, don't think about next week, think about 2030. Like, we're building a company for 2030. Well, guess what? 2030 is actually not very far away. Mm-hmm. So thinking 5 years out versus 2 years, I know you kind of touched on it a little bit, but where do you see this going in 5 years in North America? Because I think that's where things will get really, really interesting. You want to start?
Sure. I mean, I think I touched upon it. I think the landscape will look very different. I think certainly more oil and gas players, more retailers, but I think the offer to customers is going to be very different as well, right? I tell this story a lot, but I think it's super relevant, is I have 9 different apps in my phone for charging. That might sound weird for people living in Europe, but in the US right now, you drive around with 9 different apps, and I can see it changing a lot from the perspective of OEMs, but Walmart is a top 20 app in the United States. If they build their own network, is it a stretch for them to offer charging services and bundle it in with loyalty and get you to spend more in store? Like, I think the 5 years and beyond is where it gets super interesting, and I'd say the other technology piece that's interesting is right now we're using ISO 15118 for authentication, right? To make the charging experience just a little bit more easier. You don't have to pull up an app or an RFID card. But I see Florian in the audience, so he knows more about this than me. But the technology itself is kind of the foundation for a lot of other things that you can do. And what I mean by that is V2X, bidirectional charging, all those sorts of the really super interesting stuff about having a battery on wheels becomes possible. I think we have to get through that 2 years that we just talked about to get to then, okay, we can harness a lot of this technology to do a whole lot more.
More thoughts on 5 years, or?
I think we barely tapped the surface of what the potential of the U.S. market can be. For example, in the U.S., we don't truly have a dominant EMSP. In fact, it's arguably we don't even have an EMSP, right?
We have lots of them.
we have lots of like CPO EMSPs, but we don't really have an aggregation system, and that's because in the States Google Maps, Apple Maps tend to be the dominant platforms, and they'd be the natural place to look for charging infrastructure. So to figure out what is 5 years ahead, I'd almost play it forward to 30 years ahead, and let's think about what the future of EV charging could be, and how it might not be a human-led decision anymore. And so I'll put you in this sort of imaginary framework here for a little bit, just to entertain this a little bit. But imagine instead that the charger is no longer a human choice, it's the vehicle's choice. And we use routing algorithms like we have with ChargeTrip and others, right, that will automatically find the cheapest, most convenient, and available charger en route for you. And it's an algorithmic decision that you opt into, say accept or reject. And actually what's happening in the background is a bidding system between vehicles and charging infrastructure that are exchanging prices and disagreeing or agreeing on those prices to make that decision. So imagine when this is happening at scale with thousands and thousands of chargers, millions and millions of vehicles, all at different energy costs and utility rates with different availability profiles to try and charge different vehicles at different times of the day. Now, in that world, it gets really interesting because then you can also offer different pricing structures, right? So for example, you can incentivize and use human behavior to your advantage and say, right now, a lot of DC fast chargers, what we do is we throttle the charge. We'll bring it down from 150 to 50 kilowatts to help manage our demand charges and peak load. That's a function of the fact that utilization rates are low, and we need to control demand charges. But imagine if utilization rates are okay and actually pretty high. You would want to incentivize as many kilowatt hours to get dispensed as possible. But you want to disincentivize big spikes. So why don't instead you charge more for a 150 kilowatt charge, and you incentivize the driver to pay less if you let them throttle you down. So rather than throttling the charge on the back end without the driver's consent, why don't you instead prevent them with a list of options that if you charge at 50 kilowatts, you pay this rate. If you charge at 150 kilowatts, you pay 2x the rate. But if you're in a rush and you need to do it, and your vehicle has decided that, we'll do it. So I think there's going to be these almost algorithmic or mathematical games leading to the ultimate utilization and margin of this charging infrastructure. It's
such a deliberate and considered thing to charge an EV right now. There's so many decision points, and I think to Rohan's point, from 5 years and beyond, you shouldn't really have to think about it.
Right.
With all the things that are coming in with AI and everything else, I think it's going to be something where you don't really think about charging your vehicle, even less so than filling a gasoline vehicle. So,
last question, since we're just about out of time. Obviously, a primarily European audience here. We know there are some European operators that are starting to open locations in the United States. If you look at most industries, the dominant players are worldwide players. They're not regional players. So thoughts for the European operators who might quietly be starting to think about opening, extending their brand into the U.S.?
First thing I would say is utilization risk is not as risky as you may think it is anymore. There is a narrative out there that utilization rates are very, very poor in the United States. It is not the case anymore. That was definitely true. Don't get me wrong. 2 or 3 years ago, we've definitely seen that. But there are enough public companies and public data out there that actually utilization risk for public charging infrastructure is fairly low. One of the traps I see is people are eager to get into fleet charging because they see fleet charging as an amazing opportunity with guaranteed utilization, guaranteed offtake, which makes it less risky. But actually, what I would say is that we're still waiting for those vehicles. We're waiting for the heavy-duty vehicles, especially in the US. And there aren't that many fleets that are electrifying. But if you look at the public domain, if you have a portfolio of 50 sites, you could take the average utilization across those 50 sites. You might actually find that there is a baseline utilization that you can expect now in the United States, and even more broadly in North America. And we've been able to prove that utilization rates are predictable. So if utilization rates are predictable, you can underwrite that, you can finance that, you can pull a loan on that. And EVgo has shown it, right? So EVgo has pulled loans, demonstrating their confidence in utilization and their performance in the past, even with collateral of existing assets. So it is possible to finance infrastructure. So in a world where you can take private capital and deploy it, how aggressive, with very low risk, right? How aggressive can you be in the North American market? I think the answer is very aggressive.
I would just say, emphasize what we've previously discussed, which is it's a great time to enter the market. There is drivers there pushing EV adoption, regardless of federal administration. OEMs are releasing new vehicle models. We have Toyota and Honda both releasing their new EV platforms in the US before they go to other markets. We have states stepping up as well on the incentive side, driving adoption and private equity, right? So I think we're at a stage now where the market is going to grow, despite what the headlines might say. It's a great time to get into the market and start to really tease out your value proposition before it gets hyper competitive, because we know it's a big enough market that when it does happen, it's going to be very competitive.
Excellent. Well, thank you, everyone.